At this hour, the two-day national executive meeting of the BJP kick-started at the iconic Ram Leela Maidan today, and over 12,000 party workers from across the country are currently in the national capital to attend this event. Now, opening the convention, the party chief Amit Shah has sounded the poll bugle and said that 2019 contest will be between Modi versus everyone else. He also said that BJP will increase its Lok Sabha tally in these elections. For more on this, Parikshit Luthra joins us now. Parikshit, what is the sense you're getting on the ground there?
Well, this convention has been organized to motivate party workers ahead of the big 2019 battle that's coming up in a few weeks from now. Behind me is Ram Leela Maidan, where you've got about 11,000 BJP workers, all office bearers of the BJP, all cabinet ministers from the centre, ministers from different states, MLAs, MPs, all of them are inside. The Prime Minister will be speaking tomorrow. Today you had Amit Shah speaking to party workers, and he made this point very clear that this election is going to be about the achievements of Narendra Modi, about all the schemes launched by him, about his focus on opening bank accounts for crores of people, giving toilets to people across the country, improving the national security scenario of the country. He spoke about the surgical strikes as well, mocked the Mahagathbandhan, saying that the Congress and the opposition, they stand with terrorists and intruders in the country. Talking about NPAs and bank frauds, he said people like Nirav Modi, Mehul Choksi, the reason why they have fled the country is because of the strong measures taken by the Narendra Modi government. They never fled during the Congress rule because the Congress had given them a long rope. So this was the message from Amit Shah. You'll have different ministers speaking today. We spoke to many of them today, and all of them said very, very clearly that this election will be about the achievements. Rafale is not an issue in this election, and in the days to come, there could be announcements as far as the poor and farmers of the country are concerned. Back to you.
All right, Parikshit, thank you very much for joining us straight from that mega BJP National Executive meeting. Now, moving on to all the action from Dalal Street then, where markets traded lower for the second day in a row, but a sharp spike was seen in the last hour of trade, which pulled the indices off the low point of the day. The Nifty gave up 10,800 mark, ended below 200-day moving average. The Sensex managed to hold on to the 36,000 mark, and banks and mid-caps fell in line with the benchmarks. Both these indices shed about 1/5% in trade today. Shifting focus then to the earnings corner, and it was a mixed bag of earnings for IT giant Infosys. Dollar revenue surpassed expectations while margins missed what the street was estimating. Now, despite a miss on the margins front, the company hiked growth estimates for the coming quarters. For more, Reema Tendulkar, who has been doing all the number crunching, joins us now. Reema, take it away.
Well, the big takeaway from Infi is that it's betting big on growth. It's coming in the expense of margins. This is the second consecutive quarter where Infi performance has been better than TCS. So this quarter, 2.7% growth for Infi versus 1.8% for TCS. So big beat on revenues, but margins have seen a sharp contraction, falling by about 110 basis points on account of the investments, increase in the on-site cost, the acquisitions that the company have done, the lower utilizations. All that has eaten into the margins, and it's offset the benefit that the company had on account of the rupee depreciation. Profits too on account of that have missed street expectations. The full year revenue guidance has been upped to 8.5% to 9% versus 6% to 8%. So that's a big positive surprise. The margin guidance has been retained at 22 to 24% on expected lines. And in the first 9 months, the company has reported margins of 23%. They've also announced a special dividend of 4 rupees per share, a buyback of up to 8,260 crore at a maximum price of 800 rupees per share. The other growth parameters look good. BFSI growth at 8.6%, sequentially digital growth at 33% on a year-on-year basis, deal wins at $1.5 billion. So net, big on growth, but a miss on margins.
All right, a mixed bag it is, Reema. Thank you very much for joining in with all that. Now, ousted CBI Chief Alok Verma has refused to take charge as the Director General of the Fire Services. He has now written to the Secretary of Department of Personnel and Training on why he refused to do so. Remember, just last evening, the Prime Minister-led selection committee sacked Alok Verma as the Director of the Central Bureau of Investigation. Arunima joins us now with the very latest. Arunima, what can you tell us? What is the latest update?
It seems finally this curtains for Alok Verma after being sent on leave, then restored by Supreme Court, then booted out of CBI. He's finally written to the Department of Personnel and Training saying, I quit. What exactly does he say? He says that I would have retired if you had not sent me to Central Bureau of Investigation, because the 60 years of age is the retirement age. But because CBI is a fixed tenure of 2 years, even after crossing the age of 60, I continued. Now that you've decided that I do not have the capability to continue as Director CBI, consider this date as the date of my superannuation. In terms of a layman's language, what this means is his resignation, refusing to join as the Director General of Fire Services and Home Guard. That is what legal experts were also asking yesterday when the ACC, the Appointments Committee of Cabinet, their order came out saying Alok Verma will be posted as DG Fire Service till he retires, which would have been in first week of February. Legal experts were asking the retirement age for DG Fire Service is 60. Alok Verma is beyond that. How can he continue? Verma himself, without getting into that controversy, has answered. He's resigned from the services. So it's curtains down for the former CBI number 1. For CBI number 2, however, there is still the cup of woe is still overflowing, as Delhi High Court has refused to quash the FIR against Rakesh Asthana.
All right, Arunima, thank you very much for joining in. Now, speaking of that number 2 at CBI, after Alok Verma, his rival CBI Special Director Rakesh Asthana has suffered a big setback. The Delhi High Court has refused to cancel the bribery case against Asthana. The court has further directed the CBI to complete the investigations within 10 weeks and file a charge sheet. The IIP numbers for the month of November are expected any time now, and to analyse that and to take us through what is to be expected, we will be joined shortly by Lata Venkatesh. The brief preview, of course, will be up on your screens very, very shortly, and we pull up those graphics for you. IIP for October was at 8.1%, in September at 4.5%, in August 4.7%, and in July 6.5%. What should we expect for the month of November, Lata?
Well, actually, we've got a very poor number from our poll, and that poll indicated that it'll be as low as 3.8% compared to the 8% last month. But the reasons are not far to seek. The reason is because November of last year was an extremely strong month when growth was almost as high as 8.4%. So on a base like that, the expectation is that it's going to be a little difficult to do, much better. The other problem also is that we've already seen a lot of slowdown in auto sales. We know that for the month of November and December, we've had, we've got some, oh my God. I'm sorry, I can't, I didn't expect 0.5. That's a genuinely bad number. We've had a lot of problems for industrial output, but 0.5 is something, even our poll range was between 3 and 5%. Yeah. So this 0.5 is something that's just come out of the blue. It is definitely going to have a bad impact on, markets, and perhaps it can even move the Reserve Bank's hand if growth is going to be as bad as this. To some extent, we are going to see it in the, the lead indicators of auto numbers. The debt market was was seeing a lot of jitters in the month of October and November, and that could have led to working capital shortages. It could also have led to demand shortages because NBFCs perhaps were not lending. There were a whole lot of, the festival season was already over and the stocking had been done. There could have been a whole lot of reasons, but all this was factored into the 3.84. This 0.5% quite clearly is a bit of a shocker. I'm just trying to see if we can get some more details, but as always, I have a bit of a problem opening the website, but we should be getting more numbers. Let me do one thing. Let me just get comments on the overall number. We have Anubhuti Sahai with us, head South Asia Economic Research at Standard Chartered Bank. Anubhuti, I just have the headline number for you, and I'll apprise you of the other numbers shortly. But what's your take on this number itself? Just 0.5%, which means really no growth from year-ago levels.
Yeah, it's definitely a disappointing number, Lata, but in fact, we were lower than market consensus. We expected IIP to be at 1.7%. Okay. So 0.5 is even worse than what we thought to be.
Okay. I can, if you can hold on for a minute, now I can open the website and I can give you a little more. The manufacturing number is the one that's worst. That's come in, I think, at 0.4%. Or minus 0.4%. So manufacturing is the one that has let the market, let the number down, as it were. That's come in at minus 0.4%. Mining has come at 2.7%. Manufacturing, as I told you, 0.4%. And electricity is not bad. It's come in at 5.1%. So manufacturing, which is 80% of the IIP, has grown at a very poor 0.4, minus 0.4. So basically a contraction from year-ago levels, and that's accounting for this very poor performance. Anubhuti, if you can hold on for a little more, I'll try and get you the other details as well. Capital goods number is, I think, again, minus 3.4. And intermediate goods also has come in at minus 4.5. Okay, it's minus even on consumer durables and non-durables. Consumer non-durables is minus 0.6 and consumer durables has come in at minus 0.9. It's only intermediate goods, I think, infrastructure, that's come in at a plus, and that is a plus of 5%. So capital goods minus 4.5. Consumer goods have come in negative, as I just told you. This is not looking like a very pretty picture. Basic goods have come in 3.2%, so that's at least a positive number. So just once again to revise, manufacturing minus 0.4, that is 80% of IIP, and the entire industrial output for the month of November comes in at 0.5%. I'll just read out to you the individual numbers of the capital goods and the consumer goods yet again. Consumer capital goods have come in at minus 3.4, intermediate goods minus 4.5, and consumer durables at minus 0.9, and consumer non-durables at minus 0.6. So whether it's looking at capital goods, intermediate goods or consumer goods, we have a contraction compared to year-ago levels. That's a bit of a nasty jar as far as growth numbers are concerned. Anubhuti, that's the numbers I have for you. Your comments.
So I think the biggest surprise for us, and the reason probably why our numbers looked better than what has actually come in print, is probably the surprise on the capital goods. We were factoring in low single digits, but the contraction has definitely taken us by surprise. And the other important bit is on the consumer durables. Consumer durables is closely correlated to passenger vehicles, and we did see some slowdown, but probably we didn't filter in the kind of slowdown which is showing in the IIP numbers. As far as other numbers are concerned, I think it's pretty much in line with what we expected. The bigger question now is what lies ahead of us. November, I guess, as you mentioned before, there were a lot of issues, and that was the reason why market expected it to slow down, and we expected it to be at much lower level. There was a seasonality issue, there was a base effect at play, and on top of it, we did see the auto production going down. Our sense is we might see another bad print, but when you're looking at Q1, probably this should be the bottom. We should move towards an average of closer to 3.5 in Q1 rather than the decimal numbers which we are seeing at this particular moment. If you look at some numbers which have come right now, whether it is about diesel or petrol production for month of December, the PMI numbers are improving. We did see some good order flows in some of the large companies. So we can see some improvement going forward. But yes, for the month of November, the surprise on capital goods and on consumer durables has been much more negative than what we were penciling.
Well, to be fair, the April-November number is still 5%. So the good work done in the previous months is still showing in terms of growth. After all, the first 2 quarters, we had a low base and therefore very good performance. And to be fair, November of last year was also an unusually high number. I mean, if you only looked at the index number, then November last year, you saw actually a spike coming in the overall numbers as well. And therefore, perhaps, one can understand to some extent a high base also affecting. But even then, this is looking like, October over November last year was a very strong growth. But even then, this looks like almost an unpardonable number, a 0.5% growth in IIP. Anubhuti, do you think this will move the needle for the Reserve Bank?
No, I don't think. This number is important. There's no doubt about it. But just 2 points here. First of all, IIP has been an erratic series, right? So 8.1 was the October number, and from an elevated level of 8.1, we come down towards 0.5. So I would rather look at the average, the annual average, and once you take the 5.5 for FYTD in IIP and then, like a slower growth for rest of the year, we will still be looking at an IIP growth of 4.5%, which is very similar to what has happened over the last 2-3 years. So I think just this particular number, in my view, would not be the most important factor in this, pushing the MPC towards a rate cut. What really matters is the CPI numbers, and we are looking at a subdued print again at closer to around 2.3%. Given our view that even in FY20 IIP, CPI is likely to average closer to 4.4%, and given where the real rates are, we do see room opening for a rate cut in Q2. So I think that's the most important factor which we will have to take in at this particular juncture when we are talking about rate actions from the MPC. IIP plays a role, no doubt about it, because it gets into the GDP numbers and therefore the core inflationary environment. But just one particular number of 0.5%, especially given the history of this series, I don't think that would be the most important factor to watch out for.
But given this kind of a number, and December of last year also was a very strong performance. We were coming out of the GST mess, and therefore we see the numbers, the index numbers going up rather strongly. There is a big jump coming from October to November, and that continues in December and January as well. So would you worry that even the December number could be, quite subdued? I don't think before the MPC meets on February 5th. So before that, you won't get the IIP number for December. But are you confident, given this rate, that even December will be very good, or will that also be a negative number? Negative is quite a blow.
Yes, December numbers are likely to remain subdued, because as you correctly said, it was December 2017 was a very strong month too. But once you get into the first quarter, and especially if you're looking at months of Feb and especially March, you will see, rather than focusing on the monthly numbers, once you look at the average, our sense is we will go towards 3.5%. And again, when you look at the 5.5% kind of a growth for IIP in FYTD, we should still be looking at a 4.5%. And come FY20, our sense is we are likely to get an IIP growth closer to this range.
Okay.
So it's an important number, but I wouldn't get overly worried about the too bad prints, to say so.
Okay, and just a final question. You said that you're anyway expecting an inflation of, that number will come on Monday, same time. But even if that is also coming at 2.3 for you, then even then you won't expect a rate cut from the MPC on February 5th?
No, our sense is probably it makes, the 2 points here. First of all, I think it makes a little bit more sense to just keep an eye on food inflation. It has surprised us, and there is no strong reason at our end to believe that it will pick up, but probably just buying a little bit of more time to see if there is any reversal going forward. And the other important thing to watch out is, of course, oil prices. Oil prices have started moving higher in the past few days, and where it finally ends up, that will become important. The other part is that MPC is still on a calibrated tightening mode. So from from a calibrated tightening stance to move all the way towards a cut, as well as you can always switch to neutral. I think that will be too quick a move to be delivered. What was more important from the market's perspective was liquidity, and that has been amply provided by the Reserve Bank of India. So I would, those conditions, we came out with our financial condition index, and we saw that the monetary conditions are not as tight as they used to be. So I think I would take a little bit more comfort on that, buy some more time, and look at what's happening on the food inflation. Because if it reverses for any reason, you will see a big jump up in CPI number. But having said that, given where we stand today, whatever trends we see on food and the feedback which we get from APMC traders, it seems that food inflation is likely to stay subdued. So even if oil prices goes towards 70, our senses inflation will remain subdued, giving some room to MPC to unwind one of the rate hikes which they did in 2018.
Okay, thank you very much for your analysis, Anubhuti. I just want to read out yet again the numbers for those of you who tuned in late. Of course, they are flashing for you. The overall November IIP number has come in at a 19-month low. But more important than that is it is a contraction. the nation produced fewer goods, industrial goods in November 2018 than it produced in November 2017. That is the message that this IIP number is giving us, which is a bit of a nasty shock. Yes, there were debt problems. Yes, NBFCs were not able to find money. And the month before, there was crude going to $86 and therefore fears of liquidity tightening, fears of a global liquidity tightening as well, because at that time the Fed was expected to be hawkish with a crude price at $86. So a lot of negativity did add up in November, but all that was priced into our poll, and our poll still threw up, a 3.8% and a range of 3 to 5%. Nobody expected even 2 and 1%, and this is a contraction of 0.5%. Though this is a bit of a nasty jar. Yes, the IIP numbers are a bit idiosyncratic and a bit volatile. Nevertheless, they normally point at the right direction. Even if the composition is a bit questionable, they do point at the right direction. It, as Anubhuti said, it goes into the calculation of the GDP. And therefore, now this GDP number, which many people thought will almost make to 7%, will perhaps not make to 7%. Perhaps we have to be prepared for a much lower GDP number, maybe closer to 6.8 or 6.6. Therefore, you can't ignore this number. I don't see how the MPC can ignore this kind of a growth number, especially if it is followed up on Monday by an inflation number that's 2.3.
Absolutely, and inflation consistently falling and a weak growth. I mean, there's dual reasons, two big macro, points for RBI to go by. Of course, the next policy, MPC starts on the 5th of February. So that is the only additional data point that will be available by then.
The Monday number
will be the CPI number. So this definitely will have to be factored in by the MPC when it meets there. But we'll try and get you more guests to get a reaction on this very, very dismal number. Lata, in terms of, what we're expecting from the CPI numbers also, how do you think, what are the other factors that could really play in when the MPC meets in? IIP, like Anubhuti pointed out, may not be there, on top of their mind. But what we've seen from the GDP numbers, what we're expecting, especially on the food price front, what could really play up?
No, you see, the point is taken that this is a inflation targeting MPC and therefore it has to look at CPI. But they have to look at inflation targeting and give due recognition to growth as well. So if inflation is not a bother and it is at 2.3, then there will be definitely pressure to advance the expected rate hike. On the street, there are a lot of people who are, expecting. The only logic was that they have just moved to, calibrated tightening. And therefore, they will first move the policy stance to neutral in February and then go ahead and perhaps cut in April if the trend continues. So, by April, you will also get a better idea of how bad crude will be or whether it will continue to remain subdued. But now that we have a Fed as well, which is saying, and quite a few Fed members, even some of them non-voting members, have over the past 24 hours and 48 hours told us that maybe there are no more rate hikes coming. From the Fed. The whole argument in December was, how can we think of a cut when the world's biggest central bank is actually talking of a hike? Now, if that central bank is saying that, it's not going to see so many hikes, and it is continuing to say we will be patient, that's what Jerome Powell has said in the last 2 meetings over the last 4 days, then that big pressure that, globally you are at variance with the central bank has also gone. Therefore, the space definitely opens up for expectations of a rate cut from the Reserve Bank, not in April, but in February itself. Already, there are a lot of people who have said that there will be a rate cut. There are a lot of people who say that the odds of a rate cut have increased, and whereas they were putting it at, 10%, they've now increased it to 40% and 50%. Now that number will definitely increase. We, of course, have to wait for the CPI number, but this number certainly moves the needle.
Absolutely. We continue that conversation, but we are also joined by Soumya Kanti Ghosh, the Chief Economist at State Bank of India. Mr. Ghosh, your first reaction, how do you read these IIP numbers? Very, very dismal. We didn't really expect this.
No, actually, we are expecting at 1% IIP growth rate for this month. And the possible reason, I think one of the reasons which we may have missed out is that the number of working days in November, there were 10 working days short. So the total number of, there were a lot of holidays in November. So that's one of the reasons, apart from an adverse base last November. But realistically speaking, I think there has been some slowdown in demand. And after the October, and the December numbers doesn't look better at this point of time.
Okay.
And the inflation numbers...
Soumya, we don't have 10 working days fewer than November of 2017, no. It is 10 working days compared to October.
No, 10 working days in November were short.
Compared to?
In November itself. In November.
No, I agree, but we are comparing two seasonally adjusted months. We are comparing November over November.
Yes.
So for that, this kind of a fall, it looks like the debt market problem has taken its toll.
No, but see, why I take your point, that's a seasonally adjusted number, but this is one of the reasons, but I also said that demand is actually slowing down. And you will see this in inflation number, which will be released on Monday. They will see a big fall in the inflation number on Monday in both the core and also the headline.
What is your expectation?
We think it could even go below 2%.
Oh, the headline inflation?
Yeah, there is a possibility that it could hit just below 2%. And the core actually definitely should be below sub 5.5.
Okay, so do you think that all these are adding up to a rate cut in February?
It's difficult to say now because to go directly from an calibrated tightening and then changing the stance, going for a rate cut will be a little bit difficult. But if these numbers are any indication, we are actually keeping all options on the table open now.
Okay, and what about the bond yields itself? We are actually seeing them hardening. I mean, today after, being bid at 7.26, the new 10-year even went to 7.278 and the old 10-year went all the way to 7.5. The market is worried about some perhaps farm package or something like that. So do you see the yields cooling off at all?
See, I think the yields are now a function of the crude, and now there is a greater consensus in the market that crude rally which was happening and possibly hitting 50, below 50, that rally might be over. So that's why there is now a large consensus in the market that crude could actually move a little higher from here, may not be more than 65, or it could settle in the current range because Saudi Arabia is also cutting production for the current month. And if you look into all these factors, I think that is prevailing on the market, and also the fact that there is news of this something coming on the farm loan. So all these, I think, adding to the negativity. So even if the inflation numbers surprise on the downside, there could be some impact on the bond yields, but it remains to be seen how that is that outweighs the increase in the oil prices.
Oh, not a very happy combination, isn't it, Soumya? All right. Thank you very much for joining us with your thoughts. So that's not looking like a very good number. Soumya, of course, looks like he was closer to the number than others.
Not a surprise as we were.
Yeah.
Yes, and he's also expecting a fairly lower number for inflation on Monday, below 2%, as he says, which should really strengthen the case for a rate cut sometime in the future, perhaps not immediately, because like he pointed out, they can't immediately change the stance from tightening to that of easing. But, any winding up thoughts, any final comments?
Well, it's just that we are stuck between a rock and a hard place. On the one hand, we have falling output and falling prices. But as you look ahead, you're faced with a hard crude number, harder than what it was a month ago. We're also faced with a big borrowing probably by the government because of the farm package. That's not a very happy place for someone who is borrowing money, for an NBFC or, a manufacturer who is borrowing money. Not a very happy place.
MSMEs and the poor are better credits than some AAA rated companies. That's the word coming in from Bandhan Bank's MD and CEO Chandrasekhar Ghosh. Now, in a conversation with Lata Venkatesh, a day after Bandhan Bank reported its third quarter numbers, Chandrasekhar Ghosh also talked about the bank's business outlook and guided for continued strong loan growth.
After 2 years relationship with ILFS, and the first we have been started in 2016, and every people also always talking on that, the Mr. Ghosh, your portfolio all are unsecured. No poor people, no securities, you are high risk. And okay, what is in low risk? Low risk is in this type of institution, AAA, no, very renowned. SBI and HDFC is their shareholder promoter, government is their beneficiary. I feel that good, you can see that.
So what is, can you tell us the
Then we learn about it.
So
that is not only the rating AAA. That's the people, those are poor. They are the best of our retain and customer.
With that, it's a wrap on this edition of Reporter's Diary. Thank you very much for watching, but do stay tuned to CNBC TV 18.